In this video, I'm going to show you how to assess the risk of material misstatement for inventory. So we've been talking about the different steps involved in auditing the inventory account. We said that the auditor should first understand the company's inventory management process and then identify significant accounts, cost of goods sold and inventory, and the relevant assertions being made by management, such as existence, valuation, and so on. So now we're going to talk about assessing the risk of material misstatement. Now, why do we even care about the risk of material misstatement? We care because it affects audit risk. Remember that audit risk is the risk that the auditor will express an incorrect opinion when there's a material misstatement. So we don't want that to happen if we're the auditor. So the auditor needs to understand the risk of material misstatement because audit risk is a function of the risk of material misstatement and detection risk. Now, the auditor has control over detection risk. That's determined by the extent of the different tests that they do during the substantive procedures. But the risk of material misstatement is not under the auditor's control. So they control detection risk, they don't control the risk of material misstatement. So there's an inverse relationship between the risk of material misstatement and detection risk. And the reason is that the higher the risk of material misstatement is, so if we say, the risk of material misstatement is really high, then the auditor is going to need to decrease detection risk by performing additional substantive procedures. So the higher the risk of material misstatement is, say, it's really high, then the auditor better lower detection risk by doing a lot more testing. So higher client risk, aka risk of material misstatement, then we need to get a lower detection risk in order to keep audit risk at an acceptable level. This goes up, this needs to go down to keep this at an acceptable level. So what is the risk of material misstatement? When we're thinking about this, how do we even think about assessing that? Remember, the risk of material misstatement is itself a function of two other things. It's a function of inherent risk and control risk. So what we're going to need to do for inventory and cost of goods sold, we're going to need to say, okay, what is the inherent risk of these accounts? And then how do we go about assessing the control risk? So let's start with inherent risk. So inherent risk, if we say, okay, let's just say there's no internal controls at all. So just in the absence of internal controls, what is the risk that there's going to be a material misstatement? So if we just forget about the client's internal controls for a moment, what is the risk that the client's inventory account or its cost of goods sold account, which remember they're related, as we're auditing inventory, we're also auditing cost of goods sold because cost of goods sold is when inventory is expensed. Okay, so what is the inherent risk with those accounts? We'll get to the internal controls, but first, just what's the inherent riskiness of those accounts? So how do we think about that? How do we even think about what would be the inherent risk of inventory of cost or cost of goods sold? So here's three different factors that you can think about. You can think about the industry in which this company is doing business. And you say, well, why does that matter? Well, is this industry something where there's like intense competition? Are competitors constantly launching new products? And is it a situation where this company might be forced to cut prices? Maybe some of their inventory, it's on the balance sheet at its cost, but they're not even going to be able to sell it for that amount. So if that's the case, the company might need to do an inventory write-down. That gets back to the valuation assertion that management is making. Okay, they're asserting that the inventory is a certain value, but maybe actually the inventory needs to be written down. So we think about what's going on in this company's industry, but also what's the type of product. And when we think about, for example, shrinkage. Okay, shrinkage is a cost that's going to affect inventory. It's going to affect cost of goods sold, right? It's where the inventory on the books and the actual inventory are different. Maybe there was theft. Maybe employees or customers stole the inventory. Now, if we're talking about a Dollar General, it's easy for employees and customers to steal inventory from a Dollar General or Walmart or something. But if we're thinking about Boeing, it's not so easy for a customer to steal an airplane. Not saying it's not possible, just saying it's not as easy as stealing something from a Dollar General. Now, also, when we think about perishability, food at a grocery store, or obsolescence, again, getting back to the nature of the product, if this is a product, if we're talking about the company is making laptops or something, right? Some kind of technology that's going to become obsolete quickly. If they can't sell that product and then it's just sitting there, it's getting dusty, then there might need to be a write-down. So we need to think about this. This affects the risk, right? So if we're talking about technology that very quickly goes obsolete, we're going to say there's a higher inherent risk that the inventory account might be misstated. So we talked about industry, we talk about the nature of the product. Also, another thing to think about is related party transactions. Not every company is going to have this, but when they do have it, you as an auditor, it should raise a red flag. You should be thinking about this. If the company, so let's say it's a manufacturer, and they're buying a lot of raw materials from the CEO's brother. Okay, so the CEO's brother has a company, they're buying raw materials from that company, or maybe the CEO owns a company themselves, or something. There was a company called DHB Industries. You can Google it. They made bulletproof vests, and basically the CEO had it set up where they were buying materials from this other company that was actually, in theory, controlled by his wife. His wife was listed as the owner, but actually it was the CEO of DHB Industries that really controlled that entity. So what he was doing was having him buy the inventory from that other entity. So this company that he controlled was buying this inventory from this other company that he controlled at these inflated prices, and then he was pocketing the difference. That guy went to prison, so I wouldn't recommend that. But that's something to think about. Just in general, anytime there's related party transactions, particularly related to inventory, something to think about. So those are things. The nature of the product, all those different things will affect the inherent risk, right? Some types of inventory are more likely to become obsolete or to be perishable or to be stolen. And if those are the case, you're going to have higher inherent risk. Now, when we get to control risk, we've got a number of things going on. First thing is so let's just understand, what do we even talk about when we're talking about control risk? So control risk is the idea that, okay, let's say there was a material misstatement, that it would not be caught, right, or prevented. So detected is, okay, it was there, but the client caught it, and then, okay, they figured it out, they addressed the situation, or that it wouldn't be prevented. So would this not be prevented or detected by the client's internal control? So basically, high control risk. So if we say the control risk is really high, we're basically saying, hey, look, if there was a problem, we don't have a lot of confidence that the client's internal controls are either going to detect that problem or prevent it from happening to begin with. Okay, so that would be high control risk. So how do we think about setting that control risk? Well, first thing for the auditor is understanding the different components of internal control. When you see things like the control environment, and you're thinking, okay, well, what is the auditor really supposed to do? So as they get to know this company and they see, for example, that, oh, okay, I just get the feeling as I talk to different people at this company that maybe everything needs to run through the CEO, or there's one executive that basically everybody runs things through them. There's really not any kind of internal control set up. There's not formal processes for who approves certain things. For example, who has the authority to require and measure an inventory write-down? If you say, well, you know what, that all comes back to this one person, and everything at the company comes back to this one person, or there's just 2 or 3 people, there's really not a formal set of procedures, there's no monitoring of what's going on, this company's being run like a startup out of a garage. Okay, then that's obviously not a good situation. You would say the control environment, there's a higher risk when you think about the control risk. Now, so you get that basic understanding of what is going on at this company. But then you're going to perform tests of controls. You're going to do tests of controls. Now you might be wondering, well, what specific tests? I've got some things here I talk about, reperforming controls and inspecting documents. I'm going to make the next video, I'm just going to be talking about tests of controls for inventory. So we'll get to this in another video. So basically we've got learning about the internal control process, what's going on, what's the environment in this company, and then we've got testing. So we learn what the controls are, what's actually in place, but then we have to test those. Just because they say, hey, we have this internal control, we don't know that that's effective, right? So we're going to do testing of the internal controls, and then ultimately, once we do that, now we can set the level of control risk. So comes back to our risk and material misstatement, which we cared about because that affects audit risk, right? So higher risk and material misstatement, we have to say, oh, we better get detection risk down lower by doing more substantive testing to keep audit risk at an acceptable level, okay? So, well, what is the risk and material misstatement? What is that client risk? It's a function of inherent risk. How risky is the inventory, the cost of goods sold account? What type of product do we have? Is it very likely that this product would become obsolete quickly and so forth? Is there a lot of competition in the industry? Okay, those are the things that are going to increase inherent risk. And then we talked about control risk and setting that. And we're going to talk about the tests that you do, some specific tests you can do for testing of internal controls for inventory in the next video.